Hello, let's go over the sale and leaseback transactions as the last part of IFRS 16 as far as we are concerned on this course. So if you go through IFRS 16, there are other issues to look at. But like I said, for this level, we are ending on sale and leaseback transactions. So if you want to know more, you can go ahead and read more about the standard. Now, sale and leaseback involves an entity transferring an asset to another entity and then immediately leasing it back. And I was explaining this that, for example, I have an asset, my laptop. I have an asset, my laptop, and I need money. I need cash for working capital. I could give my asset to another entity, say to you. I can give my laptop to you, so you give me money. So I would have sold my laptop to you for an amount. But because I still need to use my laptop, I can still negotiate with you to give me back my laptop for a lease payment or on a lease or in a lease contract. So that's the transaction we are describing. And it is just to let you realize that there are so many means by which entities can raise money to do business, can look for money to do business. Sometimes they have to go to the bank for a loan. Sometimes they don't have the collateral to go for a loan. So these become other options they can use to access funds. And especially if it is meant for an asset, then they can go for a lease transaction where another entity will buy the asset for them to use. So they gain a right to use the asset whilst they pay rentals or lease payments in as consideration. So sale and leaseback transactions, they happen where the entity transfers its asset to another entity. So the transferring entity then is a seller of the asset, but at the same time goes back to lease the same asset from the buyer. And therefore we have a seller lessee and a buyer lessor. Now the seller then becomes the lessee and the buyer the lessor. All right. Both entities need to assess whether the transfer should be accounted for as a sale or not. So the first thing you want to deal with under a sale and leaseback transaction is to assess whether the transaction constitutes a sale. Does the transaction constitute a sale? And yesterday I was explaining that for you to assess whether the transaction constitutes a sale, you must refer to IFRS 15, the provisions of IFRS 15, in order to assess whether the sale is the transfer of the asset constitute a sale or not, right? And so in IFRS 15, you use the 5-step model and especially focus on when performance obligations are satisfied. When control is transferred, control in the asset is transferred. So you have to assess the contract details to establish whether that transfer has transferred control. Now, if control is not transferred, if the seller still holds on to the asset, still holds on to the benefit and the risk and rewards inherent in the asset, then you can't describe that transfer as being a sale. there is a sale when the performance obligation is satisfied, the asset is transferred, the seller is entitled to consideration. Go to IFRS 15. That is the point. I don't get to tell you at this point. All right. Now, what is important here is what should you do where the transfer is not a sale. Transfer is not a sale, which means you have used IFRS 15 to assess the transaction and you realize that this is not a sale. It means it is a loan. You have gone for a loan. It means I have not really sold my asset to you. I still have control over my asset. And therefore, what has actually happened is the money you have given me is a loan. The money you have given me as payment for the asset is a loan. And therefore, I will account for it as a financial liability. As a financial liability. And I will still have my asset. So I will retain my asset. Retain my asset. My asset will not leave the books. And then I'll recognize the money you give me as a financial liability. And as a financial liability, it means I will apply IFRS 9 to account for that financial liability. And the lessor, on the other hand, will also not have an asset. Will not have an asset. So will not recognize an asset, but will rather have a financial asset. Will rather recognize a financial asset, and therefore again will apply the provisions of IFRS 9 to account for giving a loan, investment in another entity, but the investment is investment in debt. So this is a loan. This is where an entity gives loan to another entity. All right. So that's how to account for a sale and lease back transaction that is not a sale. Where the transfer is a sale. So here we are assuming that you have assessed the contract by applying IFRS 15 and you have concluded that performance obligations have been satisfied and control of the asset has been transferred, risk and reward transferred to the buyer before the buyer is leasing it back to you. And therefore, there is a sale. In that case, the sale and lease back transaction will have two elements. It will have the sale, part of the sale of the asset, and part of the retention. So there will be two parts to the transaction, the sale part and the retention part, which is the lease. The part that is retained becomes the lease. So that's what it means. If you assess the transaction to be a sale, then it means we can record a sale and also record a lease. And therefore, you are applying IFRS 16 to account for the transaction. Okay, so the seller lessee must then recognize the transferred asset. The transferred asset will now be the sale. Must de-recognize. So it means you must take the asset out of your books because you have sold it. You must de-recognize. De-recognize. De-recognition means you are taking it out of the financial statement. I was explaining this. When you record the lease, you have to de-recognize an asset. So de-recognize the asset because you have sold it. You have recognized the transfer as a sale, so you must de-recognize it. And then you must recognize the sale at fair value. You must recognize the sale at fair value. So it is at fair value. Then you must recognize the lease liability. Don't forget it is a sale and lease back. So you must sell and you must recognize the lease. And for the lease as a leasee, you must recognize a lease liability, right? Which is the present value of the lease rentals, and recognize a right of use asset. So, how to calculate the right of use asset is what we are going to learn, which will be the proportion of the previous carrying value of the underlying asset. It will be a proportion. So, the asset you have in your books, you have to split it into what you are retaining as a lease and what you are sending out as a sale of the asset. So when you do that, you can recognize a gain on the rights transferred to the buyer because part of the asset will be sold, and the part that is sold is a disposal. So there will be a on gain or loss on disposal. So the element that you sell, you will get a gain or loss on the disposal. And then the buyer lessor will recognize the purchase of asset and apply lessor accounting. So we first of all recognize the asset as having been bought, and then we'll apply lessor accounting to account for it, of course, as a finance lease, because as you can see, the lessor doesn't need the asset, so it will be a finance lease. All right. So that will be it. What we'll do next is to take a question to illustrate this further. Every standard comes with disclosures, and that I leave to you to read. So that will be it about sale. The reading. I'm doing this as the reading part. You must first of all read and understand this transaction and understand how to account for it. Then we will go for the questions and solve.